You're watching BCTV. We're all about Brantford. You're watching BCTV, Brantford Government Television, a service of Brantford Community Television. This program is brought to you in part through the support of the town of Brantford.
Victor's not here.
Okay, we're going to get started with the Town of Brantford Board of Finance meeting for August 26, 2019. And first on the agenda is to approve the minutes of the July 29th, 2019 meeting.
I went through the minutes, John. I'll make a motion to approve.
Second.
Thanks, Charlie. And thank you, Robert, for second. Discussion? All in favor?
Aye.
Number 2 on the agenda is citizens' comments. If there's anyone who would like to comment on the board's agenda tonight, you're welcome. With no takers, we'll go on to number 3 to hear a presentation from GYL Financial Synergies and Hightower Advisors with regards to the performance of the town's police pension for the quarter ended June 30th, 2019, and if necessary, to rebalance the portfolio. You'll also hear of the regards to the town's volunteer fire incentive plan, as well as the other post-employment benefits plans.
Aye.
Welcome.
Michael?
Good evening. So, as customary, I'll take a few minutes and go through a recap of the global economy and global markets and their experience in the second quarter of 2019, as well as some update as to what's occurred since the end of last quarter. And then Michael and Luke will go through the specific attributes of each of the 3 funds, and we'll discuss any open items there.
All right, thanks, Rob.
So, from a recap perspective, the second quarter of 2019 was a positive quarter for all asset classes. We saw stocks, again, continue to have positive returns, albeit not as strongly as in the first quarter, where in U.S. stocks, the S&P 500 was up about 4% for the quarter. So that led most market indexes. Smaller and mid-sized companies were up slightly less. Developed international markets were up about 3.5% for the quarter, and emerging markets were up marginally. And fixed income assets did provide positive returns due to declining interest rates. What that brings you to is for those first 2 quarters of the year, the first half of 2019, is an equity environment where U.S. equities were up about 18%, where developed international markets are up about 14%, and emerging markets up about 10%. So a positive equity environment for that period. That equity environment continued through late July, with U.S. equities making new highs at the end of July. Since then, over the last few weeks of August, we've had about a 5% correction's not quite the right word, but a decrease in value for U.S. equities, about 5% from the highs in July to now. That's through, and also incorporating Friday. As most people saw Friday, we had a pretty sharp down day in the equity markets, so incorporating that in that kind of data assessment. So overall, we did see good earnings come through in the second quarter from U.S. corporations. And that continues to be the market that is leading the global environments, because the U.S. economy seems to be behaving as one of the strongest economies on the globe at this point in time. I guess the most substantive thing that we're seeing recently is the markets reacting more on a tweet-to-tweet basis versus on core fundamental data and changes of information. So there's a bit of an overreaction, which causes much more volatility on a very short-term basis, because it's a reaction to information that may or may not be accurate or complete. And that creates definitely a challenge and a lot of noise throughout the systems. And that's, very obvious if you just look at the last few days, let alone the last year, of how the markets have behaved and reacted to information. As I mentioned, the economy doing, fairly well. We still have unemployment rate below 4%. We have GDP rates that are above 2%, and inflation that is just underneath the Fed's target of 2% on for their PCE measure. The Fed did in July lower short-term interest rates by 1/4 of a point, from a 2.5% upper bound to a 2.25% upper bound. And since then, also the market environment is expecting and pricing in further rate decreases in the months ahead. Expectation of a September rate decrease of another 1/4 point, followed by 1 or 2 more Fed decreases in the Fed funds rate between now and the end of the year. So we could see the Fed funds rate go from where it's currently at 2.25% down to 1.5% by year end is a possibility if they were to cut rates by 2 or 3 times between now and the end of the year. Globally, what's interesting is interest rates globally are extraordinarily low. And that is making U.S. government debt and U.S. debt overall a very attractive asset for safe investors, which is why we are continuing to see interest rates stay low, and also the ability for this yield curve that we sit in to stay very flat. The media is oftentimes talking about inversion in the yield curve, where that means that longer dated maturity bonds are yielding less than shorter maturity bonds. When we really look at it, that point of the yield curve that is often cited right now is arguably flat at a 0% difference from 2 years to 10 years. You could argue a rounding error on whether it's inverted or not inverted today. But when you look globally and you see that globally, as of the end of last week, sovereign debt globally over $16 trillion has a negative yield, meaning that if you're borrowing money, if you're lending money to Germany, the German Bund for 10 years is yielding negative 0.6%. So that money that goes into that bond is going to guarantee a negative rate of return for the ownership of that. And that's a function of a lot of institutional demand and investors that are required to own those type of instruments, and an overly stimulative environment from some of the other very developed nations and what they're trying to accomplish to stimulate growth. And Germany seems to be the focal point of an economy that's struggling to create the stimulus and the growth and positive economic activity. Excuse me. So those are some of the challenges that we've been through and we have, and the environment continues to be overall conducive for equities on an overall basis, with the U.S. markets being the dominant environment to have exposure to at this point. So with that, I'll let Michael and Luke jump into the experience of the funds.
Great, thanks, Rob. Just an interesting aside, Rob was talking about negative yielding bonds, and it's actually moved beyond 10 years. I think, at least as of last week, and I assume it's true today, investors were willing to pay the German government to hold their money for 30 years, and they were actually willing to pay the Swiss government to hold their money for 50 years with the promise of a return of less than they were lent. So it's unusual time, certainly, for bond
50
yields.
years?
Yeah.
Okay, sorry.
I don't blame you, Charlie.
It's a head scratcher, that's for sure.
Scratch your head on that one.
Yeah.
So let's, if we could, please turn to the police pension plan, page 20, and let's look at things at a high level. One illustration we don't typically focus on, but I wanted to take a couple moments to point out is the top left of page 20, where you see the growth of a dollar chart. And we talk about performance, and every quarter we come in and we sort of, how are you doing at this point in time? And I think sometimes it's important, and we get so focused on what's happening at certain points of time, but ultimately, this really shows what's happened over time. And in the policy is the green line, and the actual pension plan is the blue line. And as you would imagine, being primarily passively invested, there is the two lines follow each other very closely. You'll notice that starting in they really overlapped each other from 2002 till 2008, and then in 2008 we got a nice little boost, primarily from the higher credit quality of the fixed income portfolio, and we see the blue line has. From 2008 really until about 2016 or 17 was a little bit higher than that of the green line. And more recently, as we'll discuss in a moment, they've converged again, so they're really superimposed over each other. So it's really showing, over time, the the plan has performed really consistent with its benchmark in the slightly higher credit restrictions when the credit markets got choppy, added some additional return. If you look at the right-hand side, the beta figure, which is something we discuss generally every quarter, that remains muted and at about 9% less volatility than that of the benchmark. So you've had returns that are really virtually identical to that of the benchmark with approximately 9% less volatility. That translates to a positive alpha or value added. You can see a few rows down there of 0.04. In dollars and cents, that's illustrated at the bottom right of page 20, and going from 4/1/03, the inception date, you can see the value of the fund was $8.31 million. Ignoring contributions and withdrawals, because that number is sort of overstated because that includes movement of money between the accounts. But if we focus in on the net cash flow, there's been about $1.18 million more in contributions than benefits paid since that time, and about $15.38 million in earnings, bringing us to the value of $24,875,000 at the end of June. So with that as a backdrop, let's turn back to page 16 and look at the overall performance. Now, this quarter, although we've had positive returns for the quarter and the year, you'll notice there's a little bit of slippage versus the benchmark. At the top line, the return of the plan has been 2.56% for the quarter versus a benchmark of 2.89, and that's bled over into the one-year number where there was a return of 5.72. Versus a return of 6.03 for the benchmark. The reason for that slippage is really twofold. One is just a function of timing of the contributions. When the market's moving up and there's cash or excess cash in the account, that creates a drag on relative performance in the short run. That's just really a function of the recent contribution that came in as the market was rallying. But more significantly, the index funds on the equity side of the equation, they can, in the near term, and we've discussed this in the past once or twice, they can trade at premiums or discounts to their underlying value, or net asset value as it's termed. And it sort of all converged in June, when folks were rebalancing portfolios. At the end of June, really all but two of the index funds actually traded at a slight discount to their underlying value, and so that created a little bit of slippage versus the relative performance. These things tend to kind of ebb and flow and work themselves out over time, but that created a drag in the most recent quarter, which bled over into the one-year number. Just one other item, or really two other items that I think are noteworthy. One is fixed income, and I think it's kind of interesting because, if we went back and looked a year ago, the general mood about fixed income was, the language went something to the effect of interest rates are going up, the Fed's being much more hawkish, shorten your bond portfolio, and a lot of people were running to cash and what have you. And actually over the past 1 year, your core fixed income was actually the highest performing asset class. As the Fed became decidedly more dovish, and in addition to the sell-off we saw in the equity markets at the end of last year, you can see for the trailing 1 year, the bond portfolio has actually returned just north of 7.6%. I think those are returns. If we asked just about anyone at this time last year, would you expect 7.6% for your investment-grade bonds in the subsequent year? Probably be few and far between folks that would have predicted that. One other item of note with regards to the bond account, you do have one bond that is in violation of the policy. There's a General Electric bond, in that GE has been downgraded to BBB+, and you of course have a AA restriction, or actually an A+ restriction on the fixed income portfolio. GE, the bonds sold off pretty dramatically earlier this year, or at the end of last year, when some of the bad news really started to come out versus GE. They've rebounded dramatically, and actually we're trading at a premium today. So we had conversations with the finance director as well as the investment manager, and that bond was sold actually today by Mezro. So it's no longer in the portfolio with regards to that, because it's a violation of the investment policy. But we did kind of wait a little bit until the bond price recovered before selling it. So that's really the high-level overview for the police pension. Since the end of the quarter, as you would imagine, there's been a bit of a decline in the market value. We're down about 2%, maybe a little bit less after the market rallied a bit today. Net reduction in value was $506,000. There was a contribution that was invested back in July, so you're right on target with your investment policy, slightly overweight to fixed income as a function of the fact that bonds have rallied and stocks have sold off in the past month or so. We're comfortable being a little overweight in fixed income, and you're well within the corridors set by the investment policy, so we don't recommend any rebalancing for the police pension this evening.
Questions on, from Michael or Luke or Rob on this pension?
Just in terms of looking out, where do you see yourself starting in the first quarter of 2020? You know, what assumptions do you work on? Because you're always calculating different scenarios.
Yep.
You know, I think it's a good assumption that we may get down to 1.5 on, but you never know what's going to happen in that market. You never know what's going to happen in the international market. And the answer is we're never going to know till it happens. But taking that into consideration, if the projections are we continue with this good economy, our government gets the foreign powers in line to what he wants to do, or a majority of them, or even some concessions that make it look like it's a real good program. What are you looking to do? If you have those scenarios, what would you be looking to do?
Well, I think in general, we continue to be, I mean, we agree with a lot of what you just said, essentially. We do, as kind of a matter of course, we update our capital market assumptions annually. Typically, that'll come in at some point in the first quarter. But, you know, if we were to kind of close the books on the year today, we continue to be constructive on equities. We think the U.S. economy is reasonably strong. The consumer is still strong, even though, you know, there's a lot of talk, well, consumer sentiment has come down. Well, it's come down from all-time highs, and it's, you know, it certainly is somewhat tied to the sell-off we've seen in the market more recently. But by and large, the consumer is strong. Unemployment is very, very low, and even the broader measure of unemployment is down to what we call the U6, which includes the underemployed. That's down to 2001 levels, so it's actually even lower than it was, you know, prior to just prior to the financial crisis. And but I think really the risk is primarily is kind of the volatility and the noise. And then, of course, we'll really be hitting the height of silly season as far as the presidential elections come early next year, and it sort of remains to be seen. You know, I don't want to stay as apolitical as I can as far as these discussions, but you know, but in general, depending upon, right now we're early in the campaign, so we're hearing a lot of the kind of, you know, on both the left and the right, kind of the extreme ideas, if you will. But as that sort of coalesces around who the candidates are going to be, and that combined with how the economy's behaving, I think will really drive things. But as it stands, we're still reasonably positive on equities and kind of neutral to even slightly positive on fixed income at this point.
Yeah. No, I mean, my sense, as an individual, I'm not speaking for the board, but we've got the fiduciary responsibility of being conservative.
Yep.
Because we're managing the town's money and the people's money that are going to get it. So, you know, sometimes people will look at a net return, and it's 8%, but the market might have had 10. But there's speculation usually in what they're investing in, that, to use the term, they got lucky at.
Yep.
And luck goes the other way too. So that's why I was just asking your thoughts about that 2020.
I mean, there's no question, you know, that Branford and this board has, as long as we've been involved, and we've been fortunate enough to be involved with you for a very long time now, has definitely erred on the side of being more conservative, and has not sort of, you know, looked to the assets to really, you know, take care of the funding requirements, if you will. The town's done its funding, and the assets have been, you know, you've been conservative stewards of the assets, and I think in the long run, that's served you well. There are towns out there and cities out there, we saw in Pennsylvania, a number of smaller townships outside of Philadelphia, some of them are 85% in equities. And, that feels really good when the market's going up, but when things go south, that's a challenge. And so we're comfortable with the way you're allocated. We added a little bit to equities last year, but you're still, arguably a little more conservative than most of your peers. You're certainly more conservative on the fixed income side with your credit restriction, and I think over time that's served the pension fund well.
Thank you.
Yep.
Mike, just to follow up to what Harry was asking, and maybe not quite related, but when we talk about the negative interest rates, and if in fact, do you see us having to deal with those within this portfolio where Jim might be happy to see a negative interest rate on issuing bonds for us to be invested in the fixed income side and facing some of those challenges? What might the strategy be?
I think it's a great question, and I think it's, with bonds, there's really sort of three items that contribute to your return for bonds. And two of them get a lot of press, and one of them most people don't really know too much about. But the first is the coupon, how much you're getting paid. And obviously with a negative rate bond, you're not getting paid anything. The second is the relative price movement. And so, that's part of the reason, in addition to what Rob said, why that some European banks and pension funds are required to own government bonds. If people believe rates are going to become more negative, then that presents an opportunity for appreciation. People that bought the 10-year German bond 3 months ago when it was minus 10 basis points, have had a real nice return now that it's minus 50 basis points. As strange as that sounds. But the other way that, in the way that fixed income managers make money, which isn't is widely known, is a concept called roll down. And that's basically that as the bond gets closer and closer to maturity, it becomes a shorter term bond. So let's just say, for the sake of argument, you buy you have a 10-year bond that has a minus 50 basis point yield, and in short term has a zero yield. Well, after 2 years, that 10-year bond is an 8-year bond, and after 4 years, it's a 6-year bond. And so as the price adjusts, as that bond becomes shorter and shorter, you'll see fixed income managers try to take advantage of kind of inconsistencies in pricing in the market. But I think, if rates continue to cycle down, or even if rates just come down in the U.S., because our bonds are very, very attractive. If your alternative is minus 0.5% for a German bond or a Japanese bond or what have you, 1.5% for a 10-year Treasury looks fabulous. And so the question is really, does the U.S. Treasury need to be paying 200 basis points above German yields? And probably not is the answer. So there's a possibility we may see, kind of appreciation in fixed income securities. But I'll just wrap it up. I know I've been talking for a while, but I'll wrap it up by kind of focusing on the point I made earlier that, we got 7.6% on fixed income last year, which I don't think anyone would have expected, or not last year, but for the past 12 months. And that is one of the few things that virtually everyone in the investment universe agrees on, is you cannot accurately and consistently predict interest rates. And that's really why, ultimately what Mesereau's doing for the pension is all about buying bonds that they think are attractively priced, using their credit research to buy corporate bonds alongside the treasuries in the portfolio. And ultimately, the market's going to yield what it's going to yield, and we just need to kind of maneuver around that as best we can. There's no magic or no silver bullet. If the 10 years yielding 1.5, we're not going to find anything that's yielding 3. That's that has the credit quality of a 10-year Treasury. So to a certain extent, we're beholden to the market, but they'll move around it accordingly.
Thanks.
I have a question. Is there any state regulation that limits, say, the maximum of either equities or fixed for municipal investing?
No.
Okay.
Well, I shouldn't say that.
On the pension, you're talking specifically on the pension side,
For
right?
general
right.
funds, yes.
Yeah.
Or
Okay.
for other types of funds, but it doesn't apply to the pension.
Okay.
And that's why we set the policy, which sets those ranges.
Well, I was thinking of workers' comp. They have a reg.
Yeah, workers' comp is generally heavily regulated, general funds are generally heavily regulated, there's capital non-recurring funds but as far as the pension is concerned, it's up to you all.
Yeah, Jim, you had a comment?
Yeah, just one thing I wanted to point out in the report. I know at the last quarterly update, we were talking about, the performance, which was historically reported as gross, and then we looked at, what the fees were, and we together put a report together, which was distributed to the board. So one of the things we incorporated going forward, and this report is the first one, so if you see on page 16, and you'll see that on the other funds as well, it's also being reported on a net basis. So we did respond to that suggestion, and we've incorporated it into the reports going forward.
Thanks, Jim.
Mr. Chairman?
Sure, Harry.
For Jim, in terms of consideration thinking, I'm not looking for an answer, it's a thought. With the markets moving in our direction for refinancing bonds, et cetera, would you consider maybe doing it in 2 tranches? Or doing one where we feel we have significant savings, and the old-fashioned statement is always, you leave a few crumbs on the table, you don't get hurt. When you try to go for the whole Megillah is when you usually get burnt sometimes.
Well, it's an interesting question, and it's something that we're looking at. On terms of the refinancing or refunding, one of the things that the Tax Reform Act did is really put you basically can't do advance refundings anymore. So in terms of our debt that's outstanding, that opportunity has kind of gone away. Our rates that we've done the last few years have been very good. Low to mid 2s, and of course our Clean Water Fund debt with the state of Connecticut, where we finance a lot of sewer projects, is currently at 2%. The demand for Connecticut high-grade municipal bonds is very strong. We've seen that in recent issues. We've seen that in Guilford. For example, Rocky Hill did an issue, and I think they got close to $3 million in premiums. That shows you what kind of demand there is for the debt. As you know, we're going forward with a lot of authorized unissued debt. I think that, given where we are now, we're likely to go larger than what we would have normally planned. Our plan was to do it over a number of years. I mentioned at the last meeting when we were talking about some of the sewer projects, which will probably be financed not in this upcoming issue, but in a later issue. So, that might fit the crumbs analogy. And again, we're keeping our fingers crossed, but if the rate environment stays good, and there's talk, and these guys follow it more closely than I do, of another cut in interest rates before the year is out, and if the bond market continues to have rallies, that's good for us. And so, we're looking currently right now at probably $45 million in the fall, and we will probably look at a substantial premium coming back to the town. Some of that would be used to augment the current debt service budget. So in that scenario, what I would be doing is coming back to the Board of Finance and the RTM, asking to increase the debt service over and above what was budgeted, as I mentioned at a previous meeting, to take advantage of that. And then the other dollars that we get in premium, well, then we could either take it into the general fund and it flows to fund balance, or we could look at it in terms of, other capital needs. For example, maybe some of that premium gets used to offset some of the sewer borrowing, and maybe it gets used to offset the balance on the middle school. And again, that assumes that project, stays where it was originally budgeted. The $88.2 million for that project, we were looking at somewhere in the area between 58 and 59 million that we would have to finance net of grants. So, after this next issue, we're probably looking at maybe like 4.1 million that would be left outstanding for the schools. So that gives us some room if the project comes under budget. It also gives us some room, as some board members may recall back in, I think it was 2016, when we originally did the financing authorization for that, there was a lot of discussion as to what to do with the old central office. And so one of the things that we had talked about was having the opportunity, if the central office was to be sold, through the process the town would have to go through to get rid of surplus property, assuming the town's not using it for its own public purpose, some of those proceeds could then get redirected back to reduce the borrowing as well. So there's a lot of things in play. I think right now that taking a good chunk off the table while we have the opportunity, knowing that there's still other things out there. The other thing too is that by doing the smaller issues, then after this, we would become what's a small issuer. And when you're a small issuer and bank qualified, you get decent rates as well. And also, your requirements for tracking bond proceeds are significantly easier. So from an administrative standpoint, I'm sure my trusty assistant on my left will thank me, maybe not tonight, but maybe a year or so from now. But so there's a lot of stuff in play, Harry, and yeah, we're not basically blowing out all of our authorized unissued debt, but right now rates are very good, and our thinking right now is, given the strong demand, is to take a pretty good swat at it, but leave some powder.
All right, so we're going to get back to the pension, but thank you, Jim, for that. You want to continue?
Great. So if you turn to tab 2, please, page 16. This is the volunteer fire. This is substantially similar to the pension, to the police pension. Similar asset allocation. Really, the only difference is because of the size of the assets, you are passively invested in all asset classes. You have an index fund for your fixed income as well. So the return for the quarter was 2.57%, 5.77% for the trailing 1 year, and the since inception number it was just in 2015 when the plans were separated. So there's a shorter history, but that's 6.03%. Since the end of the quarter, again, about a 2% decline, $22,000 in net negative returns. And the asset allocation, again, slightly overweight to bonds, but well within the parameters set by the investment policy, and no recommendation to rebalance this evening.
Okay, questions on the volunteer fire?
Good job. And then lastly, the OPEB, which is tab 1, and let's start on page 21. And again, similar, this goes back 8 years, but similar story to what we've seen for the pension, being primarily passive. It has kind of converged on the return of the benchmark. We had talked about in the past there was some nice excess return because of the decisions as to how early dollars were deployed. And we'd always talked about how, that's not going to last forever as the thing builds up critical mass and it starts to more closely hug the benchmark. And that's exactly what we've seen. But if you look at the return has been, spot on with that of the benchmark, the plan at 5.5% since inception versus the policy of 5.48. But that has come with 19% less volatility. So, with the benefit of hindsight, the decision to be somewhat methodical as far as investing, you've gotten 100% of the return of your benchmark with just under 20% less risk, and so that translates to a positive alpha or value added of 8 basis points. Turning back to page 16. Again, similar discussion as we had for the pension. A little bit of slippage more recently with regards to the performance, owing primarily to a lot of the index funds trading at a bit of a discount at the end of June, and so the return for the quarter 2.42%, lagging the benchmark a bit at 2.76, and that's true for a 1-year number at 5.36 versus 5.45, and that's bled over into the 3- and 5-year number, and then as I mentioned, since inception, really spot on with the benchmark. Similar experience for the fixed income. You can see the return for high yield for the trailing 1 year, 7.5% and 6.5% for that of the core fixed income. As far as the allocation is concerned, Again, dollars, and we were rebalanced at the beginning of the summer and invested some dollars, and, excuse me, do you have the, as since the end of the quarter, owing to it being a little more aggressive, a little more of a decline, a $442,000 decline, looks like that's roughly 2.5%. And the value at the end, or at the end of Friday, was $17,858,000. Again, slightly overweight in fixed income. You're at 36.5% versus your target policy of 35%. And so we do not recommend rebalancing the OPEB this evening either.
Okay, questions on the OPEB?
What was the balance you said, Mike?
$17,858,000.
That's as of today, or yesterday?
That's Friday's close.
Friday's close
So it'll be a
after
little bit higher today.
contributions?
After the contribution
Yes.
and after the market decline
Right,
on Friday.
Yeah, since the end of the quarter, we had $777,000 in inflows, the $442,000 of negative returns on the market. So the increase in, the net increase in value was $335,000.
Gotcha. Okay, questions on this? So we're all set. Thank you.
Okay, thank you all.
Okay, next is to consider and if appropriate, approve request from the Recreation Department Director for the following budget transfer fiscal 2019 from purchase services, repair and maintenance, $4,300 into uniforms, clothing, $500, and into utilities and water, gas, and electric, $3,800. Alex, how are you?
Good evening. On the uniform and clothing allowance transfer, we have, this last half year, we hired another full-time maintainer, and actually going into this year, we really didn't make an adjustment for it, so I might be coming back to you again in the new fiscal year. This is for old year at this point, old fiscal year. And so I'll look to make those adjustments going forward. And also in our utilities, water, gas, and electric, we started to come online with the new community house just in June. So we had a pretty substantial bill to start off in our electricity to get everything up and running. And we had some dollars that were left over in purchase services, mainly because of not having to do any work in that building itself, but some of our other expenses in the future have, just an example is like portable restrooms have increased. We've got 20 out there at this point throughout town, and that has increased from like 12. So it just, some of those costs have gone up, so I have to keep an eye on that. And I also want to just bring to your attention, I did talk to the first selectman a little bit about this. I haven't talked to Jim or Catherine as much, but going forward, we'll have to really keep an eye on our utilities this year, because we'll be coming on for our first year now with the new building. And I know that I had talked to the first selectman about that. We used to heat it by oil, so we no longer have oil in the building, and those dollars were in the GGB account. So at some point, we're gonna have to keep an eye on that coming to the following year budget. We might have to make some adjustments at that point. We're not gonna really know we go through the full year here.
Questions from Alex on the transfer?
So what is the heat? Is it gas?
It's gas and electric. No, yeah, we have gas for
Okay.
heat, yes.
It's a nice tan, by the way.
Heat pumps, yeah.
A nice tan.
Thank you.
I'll move the transfer, Joe.
Been moved, second, in discussion.
I am the parks guy.
The only question I have, Alex, is do you have a number as to what the increased operating costs are going to be for that building?
Not yet, really. Not exactly yet. I really don't know. I can't really answer that, no.
Okay.
So,
Maybe you could give us an idea going forward.
Well, it should be a net number, right, because the senior center is going to go away.
correct. Right,
You would
so,
hope?
Right. I mean,
It's going to be more.
still heated, but
right.
obviously it's not a daily usage there.
Okay, all in favor?
Aye.
Thanks, Alex. Next is to hear a request from the first selectman for an appropriation for the from the general fund into the land acquisition fund to provide additional resources for future land purchases, and if appropriate, approve the following 2019 budget transfer: from contingency, $166,000, and from bond payments, $9,000, into transfer out land acquisition, $175,000. Jim, you have a number on contingency for last year?
I do. Yes, if we look at the items coming out of contingency tonight, first one you just identified, the other one later in the agenda is $1,775 for insurance. That leaves us with $418 in contingency for 18-19.
$418? That's tight budgeting, that's good. Okay.
Well, it kind of got reverse engineered at this point.
Yeah, I
so.
bet, yeah, $418.
Yeah, but that's the year end 18.
19.
19.
The 19?
18-19.
We're in 20 now, but it was, that'd be 19.
All right, okay.
The one that ended in June of 19.
Yeah.
Thanks, Jim. And Jamie, you would like to address this?
So as the board is aware, the last couple of years, we have picked up some smaller pieces of, some smaller parcels. Summer Island Road, the most recent, Zawalik parcel, the parcel next to the community center. These are all pieces that we've picked up over the years that serve different purposes, whether connecting to our current open space or just really to improve our infrastructure as it currently exists. I do see some opportunities in this this current fiscal year. Talked to the finance director. He suggested, perhaps you have the land acquisition fund, which has been used before to acquire property. Closing out the old year, suggested we fund this so we have. If an opportunity does arise within this current fiscal year, there's funds available.
Okay.
I'll move it.
Moved?
Second.
Second. Questions or comments? All in favor?
Aye.
Okay. Next is to consider and, if appropriate, approve a request from the finance director for the following appropriations from fiscal 19 undesignated fund balance and a corresponding resolution. From fund balance, $250,000 into operating transfers out, fund 700, $250,000, and within fund 700, transfer in $250,000. And the appropriation would be seawall repairs, Branford Point, $200,000, and Supply Pond Dam repairs, $50,000. And I'll read the resolution after we have the presentation from John and others. Welcome, John.
Thank you. We left with the financial part of it. I can move into the projects.
Either way is fine.
Yeah, why don't you start it off?
Sure. Okay. So the first one, listen to the letter to Chairman here. Supply Pond Dam. That is a Class B dam, which is located really at the southern end of the supply ponds, that whole open space area. We've had an inspection in 2015 was the most recent inspection, which is mandated by the DEP to be done every 5 years. Coincidentally, the month and the year that I started working for the town as the assistant engineer, just recently got around to reading this report and really seeing some of the recommendations by the engineer that had inspected the dam. There was some money set aside for some, I won't say minor repairs, but some pointing, which is one of the recommendations in the report. There's some additional items that need some attention, I would say within the next year. Some concrete work on the spillway of the dam, just some minor things that we want to address right away, considering this is This is something that, DEP considers a significant risk if it were to fail. So within your packet, I believe you all the packet of the recommendations by the engineer. We plan to hit a couple of these, and again, as outlined in my letter, more than likely coming in front of you again to look for some money for some additional repairs, as this is an ongoing maintenance kind of thing with the ownership of the dam. If you have any questions on the dam itself.
So who maintains this?
The town is the owner.
No, I get that. What department?
We've been working with Public Works to do some of the vegetation control. On the backside of the dam, there's some large, they call it riprap in the report, but it's really large stones like you would see on a seawall. That's in case of an overtopping. It kind of dissipates the energy of any kind of, the water hitting the bottom of that dam so it doesn't erode away and compromise the structure of the dam. We've been working with them to remove some of that vegetation, which really compromises that stone and the intent of that stone. As far as everything else, it's kind of out of the purview of Public Works. It's specialized. We have to draw down the dam. 3 feet is what we're allowed to draw down the dam for maintenance actions. So you're talking about people being on some sort of raft or boat to be able to point the face of the dam. The backside, we can get a lot of that work done with Public Works with their crews, but other items are pretty specialized.
How old is that dam?
The report went back as far as 1911. That's when the dam was built. It was originally for electric generation. And was generously gifted to the town sometime in the 30s. So.
Questions from John on this?
Yeah, hey, John, the narrative seems to indicate here that consideration should be given to eventual reconstruction of the wall between the Fishway and the left abutment. Any idea when that might be, when that need is going to arise and what that cost might be?
The reason why I didn't detail that is I don't think it was a very urgent need. Most of the inspection report was to basically keep an eye on things like that. And then as we go every 5 years, we'll get those. The next inspection should happen actually in 2020. That gets really generated towards the end of 2020. And we'll really find out if there's a more pressing need for that item.
Okay.
So you're comfortable with this, Jamie?
Absolutely. To answer your question, Joe, I think yes, who's purview? I think this is a perfect example of, the town has a significant amount of infrastructure, which I think you've seen a theme these last couple of meetings. We're really trying to identify our liabilities and address our infrastructure needs. This dam itself is, as John just mentioned, is owned by the town, but it really never fell under a purview. It was there. Now DEP, and that's more of a recent requirement, I think, with the inspections, and that's what led to this report. But once again, there's we receive a report, comes in, and the engineer has it, and John then is going through all the information that he has and said, some of this stuff is more pressing than other, some stuff we need to do. Spoke to Jim, and he spoke to me about coming forward and getting funds to move that maintenance forward, because certainly we don't want to defer any maintenance further than need to be, but also I think to your question, what you were asking is who needs to be held responsible, accountable to ensure that this maintenance is moving forward, and that's something that we're addressing as well.
Okay, thanks. Because I know we put some major money in there years ago,
Yeah.
and now we go to sleep and then wake up and after a report and end up putting some more money in, and just not sure if maybe some preventive maintenance over the years might have prevented some of this.
No, I agree, and that's why I'm trying to get on top of this, is really just kind of methodically going through what the inspection report is and really taking their recommendations to heart to make sure that we stay on top of it. We've seen a lot of deferred maintenance issues in town that I'd rather not come in front of you for large chunks of money to...
Yeah, you're just the messenger at this point.
So,
All
John,
right.
I'm sorry, Joe.
Go ahead,
So
Bill.
John, this is going to be accomplished in 19, or is this going to spill over to 2020?
We have plans to do most of the work in fiscal year 19.
Okay.
Hopefully have,
Fiscal year 20.
sorry, fiscal year 20, yes. Have a little bit left over for anything else that we may have, so we don't have to continually come back and ask for more. But we will get that next report at the end of 2020.
Yeah, 'cause
So
I do remember Janice coming in front of the RTM for dollars for this.
That was
so-
17,000.
Yeah, yeah.
yeah, I would hope to, within the next inspection report, have something by the next budget season that we could really start working this into the budget.
Thanks.
Okay, thanks. You want to cover the seawall issue?
Sure, so the Brantford Point seawall, as outlined in the letter, we received some notification in May and June of this year with a request to take a look at the Brantford Point seawall. We did, with the help of the Brantford Fire Department, they did take us out on a boat to be able to inspect the wall itself. At that point, as you can see in some of the pictures that were included in your packet, we did see some concerning partial failures of the wall. Clearly something that we want to take care of sooner than later. And this, let's see, in July 19th is when we got the report back from the coastal engineer with their recommendations to rebuild the wall, which includes, unfortunately, taking off part of the wood wharf that's on top and rebuilding the wall, replacing the wharf on top at the end of the project.
So now it's limited, fairly limited scope?
They've identified the portion of the wall that would need to be rebuilt. As far as the rest of the wall in the report, they did find it to be sound, satisfactory. So we wouldn't be planning on doing anything else to the wall at that point.
It's just this corner?
That one corner had a, I would call it substantial failure. They called it a partial failure. It's concerning to me.
That's the upstream
Yes.
side?
East side.
Yeah.
Right, so as part of their work, they gave an estimate for the work. We're unsure of exactly what we're going to hit in that area. There's at low tide, you can't really get a visual of what's, there's still water. You can't see what the ground elevation is, what the elevation of the sound rock is underneath, so
When did that cap get poured?
there is actually no documentation on that wharf and when the cap was poured on top of the wall. It's a fairly large cap though on that, and that it looks like it was part of a repair at some point in time.
Right, was that recent when they put the new deck on, or was that done before then?
There's no documentation in the engineering department. I don't know if anyone else can
Somebody
speak to
knows.
that, but
Somebody
We were
knows.
going, pouring through stuff I was even asking, but I think, was that late 90s, was that in the 90s?
I think it might have
Mid
been.
to late 90s?
Yeah.
Yeah, when they did the new deck and then the concrete up.
Right. So they poured the cap over, but that's where part of the failure is
Underneath.
under the cap.
Yeah.
under the cap, it looks like the cap may have been part of a repair of that top section.
Right.
If you look at the cap under the rest of the wharf, it's
Okay.
considerably thinner. Yeah.
Okay, Charlie?
Hey, John, photograph 23 shows rot on the pile. Now, would you be replacing a pile?
Yeah, so part of their comments and their inspection and part of what we saw, actually photograph 23 is when we were out there, we saw a bird flying in and out of there. So it's pretty evident that needed to be replaced. So that happens to be on the side of the partial failure. So as we take that wharf apart, in my professional opinion, I think once we don't salvage those pieces, we rebuild it at that point in time. So there's additional money built into the request that we're asking for to be able to replace those.
You drive a pile.
There's some piles that need to be replaced due to ice damage, and then the pile cap itself is deteriorated. As long as we have everything up and out, we might as well replace it this time.
Okay, so thanks for that portion of the presentation. Jim, would you like to cover the fund balance, creative financing part?
Sure. I guess I should go back a little bit because, we have in the past used fund balance for capital projects during fiscal years. For example, in January, we took $1 million out, which we then set up the Coastal Resiliency Fund. Back as part of the budget, we took $475,000 out of fund balance and another $325,000 for capital projects, to $475,000 going into the police pension fund. And sort of one of the universal themes in all that is if we're using it for a capital one-time item as opposed to using it exclusively for operating costs, then once you do that, the project's done, and then you have the flexibility in future years as opposed to using it, say, to cover electric bills. And in this case, when we're looking at where, and it's still a little rough, but where we think we might end the year is in fiscal 18, our total fund balance was about $30.6 million. The unassigned was about $27 million. And, we still have some closeout to do, and, we need to manage expectations a little bit with our bond sale coming up. But we're anticipating that unassigned, when you take into account the year end, the $2.8 million that's allocated in the current year budget, and then there's usually some other assignments. We're looking at it unassigned roughly about $28.4 million. And so at this point, when we look at some of these things, these items were identified after our budget development. And as Jamie pointed out, as we did last year, as we start winding down the years, we look at some of the things that, where are some opportunities out there that we don't have to tax for in the future. And that's the common theme with the property. That was a theme last year with the Zawalik property. And I was aware of the issue with the seawall because that came up a month or two ago. And then the dam, I knew we had 17,000 in it, but in terms of John making me aware of that situation and Jamie as well, we felt that we should add some money to that, with the sort of caveat that future repairs will likely be required. But anything we do today or put aside today is less we would have to tax for in the future or find some other way to appropriate for it.
So you're comfortable with this $250,000? Questions from Jim on that presentation? If not, I'll read the resolution.
I'll move it.
Let me read this, Harry, because we have to actually increase the budget. So resolve that the Board of Finance recommends to the RTM an increase in the appropriation for fiscal 2019 general fund budget from $113,969,473 to $114,219,473. This increase will be funded through an appropriation from fund balance and will be used to fund capital improvements.
I'll move it.
Thanks, Harry.
Second, Joe.
Second by Jeff. Discussion? All in favor?
Aye.
Okay, thanks, Jim. Item number 9, to consider and if appropriate, approve a request from the finance director for the following closeout budget transfers 2019. Thank you, John. For elections, from membership and conferences, $260, into seasonal and part-time, $260. From GGB, general government buildings, from wages and salaries, $3,040, into accumulated sick. For public works, from wages and salaries, $4,000, and other fuel, $14,615, for a total of $20,615. Into various items, overtime $7,200, seasonal and part-time help $6,000, other purchase services $1,402, and road painting and signs $4,013 for a total of $20,615. For municipal insurance, from contingency, $1,775, into property insurance for the same amount. And for Willoughby Wallace Library, from library staff, $250, into longevity, $250. And for a special detail, it's a little different, but we'd be increasing the revenue side by $90,000 for special detail, and increasing the appropriation expenditure by $90,000 as well. So I'll read this resolution for these transfers, and then we can have discussion on it, or questions. Resolved that the Board of Finance recommends to the RTM an increase in the appropriations for fiscal 19 from general fund budget from $114,219,473 to $114,309,473. This increase shall be funded through an increase in estimated revenue derived from special detail receipts and will be used to offset special detail expenditures. So you have multiple transfers here, which I've gone through. Jim, any explanation or additional comments on these?
No, unless you have specific questions.
Okay, thanks. Questions on this, on these cleanup transfers? Moved by Bob.
I'll second it.
Seconded by Jeff. Discussion? Oh, I'm sorry, yeah, it's 18,000.
Yeah.
Yeah, 18,615.
We saw that. but
I get carried away.
Hit the numbers, we'll just do it.
Should have called me on it.
Well, no, we just figured
That's it.
we'll get entered that way.
Discussion? All in favor?
Aye.
Okay, so with no other business to come before the board, I'll entertain adjustment to adjourn.
I'll move it.
Moved and seconded. All in favor?
Aye.
Thank you.
Wow. Nice
This
job.
program was brought to you in part through the support of the Town of Brantford. Watch town meetings and other videos on demand at BrantfordTV.org.